Don't get stuck paying the IRS more money than you have to. Over the course of your retirement, many people are expected to pay north of 6 figures in taxes alone, above and beyond what they normally pay for their other income streams. So the 6-figure tax bill is sitting there quietly behind the scenes. It hides in your retirement accounts. It also hides in lack of knowledge or knowing how to file your taxes properly to take full advantage of the different tax benefits you're allowed to do so. So today I just want to give you guys a couple of tips on things that you could be doing or thinking about in order to bring your tax bill down in retirement. So the first one is going to be monitoring your pre-tax retirement accounts. Remember that pre-tax retirement accounts just means you haven't paid taxes on that money yet. So if you look at your Plan 3 or 4-3 statement or deferred comp and it says, hey, you have $200,000, remember that that's not all yours. How much of it is yours depends on when you take it, how much you take, what taxes are at, and things like that. So it can vary greatly. A lot of people assume that, hey, I'm in the 22% bracket, 22% of it is going to go to the IRS. And it could be true depending on if you stay in that bracket. But if you take too much out at once, you could find yourself in the 30-some-odd% bracket. And, obviously pay more taxes at that point too. Also, it's important to remember that your money is invested. It's going to still grow. Even though you're not contributing to it anymore, over time, if you're not withdrawing it, it's still going to grow and earn. And when you've accumulated a large amount of money, it doesn't take much interest for it to grow rapidly. $300,000, you get a 10% return. That's another $30,000 of your account. That $30,000 of growth, if 20% belongs to the IRS, now that's $6,000 more in taxes you owe to the IRS now, just because it grew. You didn't do anything wrong. It's just that's kind of the deal you make when you have money in the pre-tax accounts. Every time the money goes up, they're going to get a piece of it. So if you want to avoid that, you need to start being strategic on where you invest your money so you can get tax-free growth, or at least more tax advantage growth. So that can be done in after-tax retirement accounts or using Roth accounts. Now it's going to depend on what tax brackets look like in the future or what your income looks like. But for most state employees, if you're going to have a large pension and Social Security, oftentimes people aren't changing brackets. You might go from making $200,000 a year to $100,000 as a couple. You're still in the same tax bracket. Your bracket hasn't changed, even though you're making $100,000 less. And that's usually a big kind of light bulb moment for people. They don't realize that just because you're making less or half as much money doesn't mean you're necessarily in the lower tax bracket. And every dollar you pull from that traditional retirement account is going to be taxed as if you were working. So tip number one is just be a little more knowledgeable of where your retirement savings is going to and how that's going to affect you in the future. Tip number two is try to avoid being on autopilot. We've all heard the phrase set and forget it. That applies to your retirement contributions, how much percentage or dollar amounts you're doing each month. That is definitely a set and forget thing. Some people also say it's for investing. You could, set your investments up and kind of forget about it. At some point in your earlier career, sure, as you get close to retirement, you want to start monitoring it to make sure you're not taking on too much risk. But the real big point here is set and forget it should not apply to how your contributions are taxed. So people that set it up to only do 403B on a pre-tax manner, only do deferred comp pre-tax, and then forget about it and don't ever think about, hey, is this really a good idea? Should I have switched to a Roth? Or they, just kind of lack the time or knowledge to know when or who to talk to about that switch. Often find themselves up with these large pre-tax retirement accounts, and then we're going to spend the good chunk of their early retirement years doing conversions and paying large amounts of taxes to the IRS in order to reduce our future tax bill. So we want to set and forget it, set your contributions up, investments to some degree, but when it comes to your contributions, you should be reviewing it I would say at least every year, but at least every few years, especially if there's a major tax change, to say, hey, is this really still the best thing for me? Is putting money into this pre-tax 403B account really what's going to benefit me the most in the long run? Or should I be shifting to doing more tax-free savings? So in retirement, it's important to have your money in different buckets. If all you have in retirement is pre-tax account, that means every dollar you take in the future is going to be taxed. And if taxes are an unfavorable rate and you need the money, there's nothing you do about it. You're basically going to be forced in a way to pay higher taxes in the future. If you have money set up in other accounts, like a brokerage account where you already pay taxes on the money, or a Roth account where it's all tax-free, if taxes are 35% and you're like, hey, I don't want to pay that, you could pull money out of the Roth account for that year. You already paid those taxes back when taxes were, the 22, 24% rate. So therefore, you're not going to pay taxes in the future when you pull money from that Roth account. So it's kind of a way to kind of legally manipulate your taxes in the future. And it's only possible if you have money invested in different tax type of accounts. We call it tax diversification. So how can this tax buckets really save you up to 6 figures in retirement? So easiest example to explain it is if you had an account, it was pre-tax, meaning that we haven't paid tax on money yet. Let's say you had $100,000, it was deferred comp or 403 or something like that. And you just say you're 52 and you just kind of left it there. You stop putting money into it. You got $100,000, you're going to start saving somewhere else. Great. So if you just, let's just say the taxes on it was 25% for easy math. So $100,000 in pre-tax, roughly $25,000, it belongs to the IRS. They haven't, taken their taxes out yet, but I know I owe them that much money. Over the next 10 years, if that $100,000 grows and becomes $200,000, and by the way, it's only about 7% average rate of return to do that, double your money in 10 years. Now the account's $200,000. If taxes are stayed the same, nothing changed tax-wise, I still owe 25%. I now owe 25% of $200,000, not the 100. So now my tax bill is $50,000. So in other words, the IRS just doubled the amount of taxes they can collect from us just because we put it off doing anything with the pre-tax money, just because of the growth, really, right? The taxes just doubled in those 10 years. On the other hand, if we had $100,000 and it was a Roth account, meaning we paid taxes at that time, so let's just say we paid $25,000 initially on it. So that's what we paid over the course while building up the retirement account, or maybe we did a conversion. We said, hey, we're going to convert $100,000. We'll just send them a check for $25,000. Great. So that $100,000 now is tax-free. Same scenario, 10 years, it goes up to $200,000. My tax bill it's $25,000 still. It's what I really paid them initially. So you're paying off the IRS, you're getting them out of your pocket, you're not doing business with them anymore, you paid them initially. So all the growth you get in the future is tax-free. So account value's the same. You're looking at $200,000. One, we pay $25,000 on. The other, every time it grows, we're going to increase the amount of taxes we owe. And that would be $25,000. Now that's just on a $100,000 account. If you're looking at an account that's, $500,000 or $1 million, just add on zeros to those numbers. You can see quickly how that $25,000 in savings could become, $250,000 or $1,000 or more in tax savings alone, just from being a little bit more strategic with your tax savings. Now, there are 3 other mistakes I see that are commonly made for retirees that directly impact their taxes and cause them to pay more than they really should. So mistake number 1 is failure to make quarterly payments. So remember that in retirement, you're not employed anymore. You are in charge of how much taxes get withheld, and you're responsible for paying the IRS yourself. So Social Security, unless you fill out the correct form, which by the way is not included in the application, you have to go find it on your own, download it, sign it, and mail it in separately. Social Security does not hold taxes for you by default. When you go to fill out your application for your pension, there's going to be a section that says how much taxes you want withheld, and you have to fill it in yourself. There's no worksheet or anything like that, or anyone to talk to kind of help you make that decision. You could talk to an advisor or CPA, but anyone that talks to a DRS, they're not going to be able to help you because that's a tax-related question. They don't want to get into all that. So it's up to you to determine how much taxes actually get withheld. Anytime you want to take money out of your retirement account, it's up to you to make sure money gets withheld from that transaction. It's not required for money to be withheld. Some institutions will recommend it or have it on their form, but it's ultimately up to you when you sign the document to make sure that enough is being withheld. Otherwise, you're going to be met with underpayment penalties. So if we don't have enough money withheld throughout the year, when you go to file your taxes, you're going to see underneath the line that says how much you either owe or got back, how much of it was going to be assessed as an underpayment penalty, meaning that you didn't pay them enough throughout the year. One thing people don't know with this is the IRS is just like us. They like getting paid evenly throughout the year. They don't want to wait till April to get the money that they're due. So if we did pay them enough taxes each year, and in January or February, so we made an estimate payment saying, oh, sorry, I was short, here's the money back, they're still missing that money from Q1, 2, and 3, they're going to still assess a penalty on you, even if you paid up all the taxes you were due, because that payment is now considered late. So they want to make sure the payments are done on a quarterly basis. So one little hack with this to get around this rule is if you take money from your retirement account, you're able to send up to 100% of it to the IRS. So instead of making an estimate payment to the government where you went on the website and said, hey, I'm going to submit $5,000 from your bank account, that they count that payment as the quarter it was sent in. But if you know you're short, and to get around the payment penalty, so you're trying to do this in January, before the Q4 deadline, if you took money from your retirement account, let's say it was Plan 3, and you said, hey, I want to take $5,000, but I want 100% of it to go to the IRS. So basically, you're making an estimate payment to the IRS from your Plan 3 account instead of you doing it directly to the website. Because it came from a retirement account, it's considered evenly paid throughout the year. So even though you did the same payment at the same time, It's just for the source that it came from. The IRS considers it paid evenly throughout the year, and that would be one way to avoid the underpayment penalty, or at least reduce it at the very least. All right, so always make sure that you're having the proper amount of taxes withheld and paid evenly throughout the year to avoid underpayment penalties. If you need help with that, make sure the advisor you work with actually does tax planning, meaning that they talk to you about taxes, they review your tax returns, or work with a CPA that also does this. That's probably the best way to make sure that you're not going to get hit with this type of stuff. And most advisors don't do this, so don't assume they do. If all they talk to you about is investments, especially if they work at a big firm, and they never ever look at your tax return, or they're only looked at it once 5 years ago, they're probably not going to catch this kind of stuff. In fact, just a few months ago, I've met with a couple in Ellensburg. They worked with a large firm. Can't say their name, but they're, kind of a bigger firm that a lot of people would know. And they had a CPA they've also worked for years. And neither one of them ever told the client that they were getting hit with an underpayment penalty. And they've been doing this for the last 4 or 5 years. They've been working with them. And not once did either of them ever catch it. And within, 15 minutes of the conversation, it's the first thing I pointed out. And they had no idea that was even happening. And I told them how to fix it. So don't assume that the advisors, CPAs are always going to catch these type of things. Make sure it's someone that's really more tax focused and actually reviewing your returns. Just because they file your return doesn't mean they actually review it. Remember that CPAs are tax filers. When it comes tax time, they're so busy that all they're trying to do is get through the returns. Some of these people have to do 100 plus tax returns a year, if not more. So when they're charging you $100, $200 to return, they're just inputting numbers, making sure that everything checks out, nothing looks totally off, and submitting it. They're not making sure that it's correct for your situation or all the forms are filed. If you didn't give them the form by mistake, they're not going to catch that because they're just moving on to the next client. So make sure you have an advisor that's looped in with your CPA so you can kind of catch these mistakes ahead of time. Second big mistake, I'm seeing it a lot lately. And again, it's the same firm I mentioned earlier. Their name, I guess you could say, it rhymes with Ted Groans. Because of the way that they're designed, they only make money when they either sell products or when you move money and they can invest it and they charge you a fee for it. Because that's how they operate, it's the only way they can earn money. They find any way possible to make their money, even if it's not in your best interest or doesn't make sense. So the strategy that they're recommending a lot lately, and 10 years I've never actually done the strategy. We've talked about it with a few people, but it's never really made sense for, say, employees. And that is the backdoor Roth conversion. So if you're not sure what the backdoor Roth conversion is, basically Roth IRAs, they have income thresholds. If you make too much money, you can't put money into a Roth IRA. But you can put money into a normal IRA. There's no tax benefit for it. And that enables you to do a Roth conversion. So basically move it from that normal IRA into a Roth. You can only do the annual limit of the $7,000, $8,000. And that's just kind of like a workaround for it. But it's a lot of process, right? You got to open up the traditional account, open up the Roth account, you do the contribution, fill out the conversion paperwork to make the switch, and it has to be reported correctly to the IRS. So there's a lot of things that has to happen in order for it to be reported correctly. And if it doesn't get reported correctly, you don't get credit for it, and you could get actually hit with a penalty because the IRS might think you did a Roth contribution instead of the conversion. So doing these complicated strategies and not reporting correctly is like a kid going home to do homework and not turning it in. You can do all the work and swear it was great, but if you don't turn in, you're not going to get graded and you're going to fail the class. If you don't report the correct tax forms to the IRS, they're not going to know what you did, and they're going to hit you with the penalty. Similar way the kid will get hit with an F by not turning the homework in late, you're going to hit with a tax penalty, potentially, just because you didn't have the correct form, filled out. And all those fancy softwares, they're not going to know to check for this type of thing either. So the workaround for it, and the reason why I never use it is, with state employees, most of you guys now have, there's usually a Roth option to save into. So we have Roth deferred comp now that just came October, and that's universal for everybody. So there should be pretty much almost nobody doing backdoor Roths anymore. Now that you can do up to $30,000 into Roth deferred comp. On top of that, if you're a school district employee, you have that option available, but most districts also have Roth 403Bs, separate tax code, another $30,000. So between those two accounts, you could be doing up to $61,000 alone per year into a Roth type of account. In fact, many private employers have Roth 401k options. So for the few times I did meet somebody that we were considering this option, oftentimes once their spouse checked with their employer and they had the Roth option available to them, they were able to just use the Roth 401k at that employer, and 30,000 contributions is more than most people can afford to do anyways, and usually it took care of them. And there's no need to do this whole complicated conversion strategies. So now what happens when you do these type of strategies and doesn't report it correctly? What kind of penalties are there? So with Roth IRAs, if you make too much money, you contribute into it, it's considered an excess contribution. That contribution needs to be removed, plus any interest you earned prior before the tax deadline, April 15th. So with these excess contributions, the IRS is going to administer a 6% penalty on the money, plus any growth that money earns each year it sits in there. So if you never look at the account, don't read the letters they send you, if they send you any at all, that's a 6% penalty. So in number terms, if I put $7,000 in, I was way over the limit, I wasn't supposed to put anything in, a 6% penalty is going to be around $420 or so, per year. Plus if it grows, any growth I get, technically I have to pay penalty on that as well. So that money has to be removed ahead of time. So the couple I met with at the beginning of the year that did this last year with that advisor didn't know better, they already filed their taxes. So, maybe they can get the money out, because I guess you might have until the October 15th deadline potentially to get it out. But I wouldn't, bank on that. It's just easier to avoid the situation altogether. So if I didn't catch that, chances are they would have got hit with an additional $400 some odd in taxes next year. And then the CPA would be pointing fingers at the advisor for not letting them know about it. The advisor would be pointing fingers at the CPA saying they should have known better. And it's not a good situation. So it's always important to make sure you have a team together, that your advisor and your CPA are on the same page and communicating, so this type of stuff doesn't happen. So when I do Roth conversions for our clients, I don't do backdoor stuff, but I always make sure that their CPAs know. I send them a letter in January saying, hey, we did a conversion. This is how much we converted, and this is the tax forms you need to look for. And it's a checklist. They give it to their CPA. So when the CPA is going through tax documents, they see the list, they know what to look for, what to expect, or the reason why that form is there. So it just makes the filing process a lot smoother when the advisor and the CPAs communicate. Next tax tip, I see this not super frequently, but it does come up, so I just want to address it. Back before tax rates changed and the standard deduction went through the roof, giving money to charity actually gave you some type of tax benefit. Now, unless you're giving a significant amount, you're not really going to see much benefit. So, example, I have a client that every year they want to give about $30,000 to different organizations. So it's about $30,000 a year is what they're giving. After they also deduct whatever they can, property taxes, stuff like that. I mean, they basically itemize. It's like $40,000. So because standard deduction is about 30 now, and they can itemize 40, that $30,000 that they give away only really gives them a benefit of about $2,000. So the math on that is $40,000 is what they itemized for. Standard deduction was 10. So the net benefit of how much they could write off was only $10,000. 24% tax bracket off of $10,000 is about $2,400. So you gave away $30,000 and you got $2,400 tax benefit. That's less than 10% benefit. So you always want to make sure you're giving money away to organizations you care for, because you care for them, not for the tax benefit, because you can see it doesn't really work out for you in terms of taxes alone. So if you're giving less than that, if you're only doing a couple $100, a couple $1,000, and you're not over that $30,000 threshold, not itemizing, don't expect to get any kind of tax benefit from your generous donations. Now, there are some strategies you could use to potentially do that. So let's say you were giving, let's say it was $20,000, so not enough to get you, to itemize, or maybe you're itemizing by just a little bit. Maybe you got the $32,000, you could itemize, and maybe you got a couple bucks back in taxes. What you could do is actually lump multiple years together and use a donor advised fund. So what all that means is, instead of giving, let's say you give $20,000 every year. So instead of giving $20,000 every year, you just saved it up. So you had, let's say you saved for 3 years and you had $60,000. And then at that point, you put into a donor advised fund. So a donor advised fund is basically a giving account. So once the money's there, it has to go to some charity at some point in the future. It's not mandated of when or how or who. It's up to you. It just has to go to charity. You can't get the money back once it's in the donor advised fund. But the donor advised fund, what it allows you to do is, once the money goes in, it immediately kicks you out that benefit. So you don't want to give $60,000 to charity all at once. I don't blame you. Put in the donor advised fund, and then over the time, you can distribute it to who you want to give that money to. But the benefit there is you get to realize the benefit of that $60,000 in year one. So instead of having $20,000 of giving plus some write-offs, and then you might get to $30,000 for the year and not really make much money as far as tax benefits. If you did $60,000 of giving plus you itemize whatever sales tax and stuff on it, maybe you got to $70,000. Say standard deduction is at $30,000, you're $40,000 over the threshold now. Now that $40,000 is what you get to write off your taxes. Again, 24% bracket. Now you're saving about $10,000 in taxes alone, just because you were smart in lumping those contributions together just for those 3 years. So just an example of what donor advice funds are and how being strategic with charitable giving can potentially give you a bigger tax benefit. So you still give the same. Right? We're just going to change the method of delivery to enhance your tax benefits. So that was a lot of information. If you want to talk more about any one of these particular strategies, or just need help in general with anything going on in your financial life, need an expert on your side to dig into your state retirement benefits, your tax planning piece, or you're ready to pull the trigger in retirement, you want to make sure the numbers will work out, feel free to book a call with us at any time. The link to do that is going to be in the description below. And always remember that your future depends what you do today.